Hello and welcome to IB Times TV. I'm Jessica Minton, and joining me today is the senior editor of Money at IB Times, Greg Morcroft, to talk about how the Dow and the S&P are hitting these record highs after Bernanke's comments yesterday. So, Greg, it's amazing how the markets are able to just have this psychological effect from Bernanke's comments. Why is that so?
Well, we've been in a period now for several years of extremely low interest rates, so-called quantitative easing, where the Federal Reserve is making sure that there's plenty of liquidity, lots and lots and lots of money in the market. What a lot of that money has done has been to go to assets like stocks, emerging markets, gold, these assets that are a little bit riskier because the cost of borrowing the money to invest in them is so low. Late May, Mr. Bernanke made some comments that were interpreted by the market that eventually, sometime, this may be the first signal that they're getting ready to think about making rates a little higher. So what he said over the past several years is that he'll give the market plenty of notice. Well, what the market did, being what the market is that the first hint of it sort of all ran for the door at once. So you saw big declines in the U.S. Stock market, but even more so overseas. And so clearly, since the end of May, when Bernanke made those comments, the market has been nervous, and I think the Fed has been nervous about the the comments that Bernanke made. Yesterday, he came out after the market closed, after the release of the latest Fed minutes, and basically reiterated the tone and the language that he's used before, which was that policy will remain accommodative for the foreseeable future. In other words, everybody don't worry, I hinted that it's going to be higher, but we're not ready to commit to actually making it higher in September or December as people had expected before. So there was a period of about 6 weeks where the market was uncertain as to the pace at which this tightening or more restrictive policy was going to take place, and that we saw the market fall. Now that worry's been taken away. And just as quickly as it fell, now we're back at highs, all-time highs, looking like we're going to close there.
Do you think the global financial markets are becoming too dependent on the Fed's stimulus measures?
Well, yes, in a word, but would qualify that. The Fed's measures are intended to make the markets dependent on them to a certain extent. A lot of people talk about how the easy policies of the last few years will only end badly, it'll end in inflation. Bernanke actually, a lot of people will tell you, is much more concerned about deflation, a 1930s style sort of death spiral where people lose all confidence, where money is tight, people are waiting for prices to go down so they don't buy things, and he's been trying very hard to avoid that. Some people would say that it's kicking the can down the road for inflation, but it seems to have been successful to a point. We're still not growing the way we should be. There was some data out this morning that showed there's still some problems in the employment market. Unemployment is still around 7.6%. So while we may be stabilized and we may see the stock market very high, the overall economy is not out of the woods by any stretch.
Now, it is interesting because there is this disconnect between the market and the economy. Just because we do have these market highs in the Dow and the S&P doesn't necessarily mean that there is job growth. Do you think the Fed's worried that it is creating an asset bubble with quantitative easing?
I think, as I mentioned before, I think the Fed is aware of the effects of its policies and wants those effects to continue for the time being. Ideally, I think the Fed would love to see the economy catch up to a certain point and then have its policy tighten and get back together. But yes, I mean, they do create asset bubbles. I think the last 6 weeks that we've seen is a perfect example of what an asset bubble is. It's inflated, then it's deflated, and now it's being inflated again. I think they're aware of it. I think that they certainly would be loath to take a step now that would crash the markets. And I think they probably got a little nervous seeing the effects that the comments in late May had. I think they're aware of it as much as anybody. Whether they worry about it, I'm sure they worry about it sometimes. Yeah.
And finally, Obama has still remained kind of unclear on whether or not Bernanke will have another term, which would expire in January. Do you think that we will see Bernanke in a third term?
I doubt it. I mean, this has become one of the great parlor games for people in our business in the last month or so. Who will replace Bernanke? Mr. Obama, President Obama, raised some eyebrows a few weeks ago when he made some comments about Mr. Bernanke coming to the end of his third term. Those comments were interpreted by some in the market as a not so subtle signal that he wouldn't be back. Personally, I think if I were Ben Bernanke, I'd be pretty exhausted. I wouldn't mind going back to Princeton and teaching some classes. But right now, it looks like Janet Yellen, who is the vice chairman of the Fed, should be the first female head of a major central bank. It looks like she probably will get the job. At least that's where the money on Wall Street's betting.
Well, Greg, thank you so much for your insight.
You're very welcome.